Now we get to the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next few weeks. We're going to speak about interest rates. Interest rates always seem to be one of the three categories on the list. And we're going to talk a bit about what goes into whether the interest rates rise or fall, some of the macro data, a lot of it we've been receiving out of the US macro data in the last few days. Investors' returns, or in some cases, lack of returns over the last few years. We'll speak a bit about that. And dividends playing a big role in terms of how much growth investors will experience or have in their portfolios. We all know that dividend payers go a long way to in helping individual investors grow their portfolios. So we'll speak about those three things. So let's move to the first topic, which are interest rates. And I wanted to touch on interest rates because interest rates continue to drive the bus with respect to the stock market, right? Interest rates up and down, and as they move higher, as that 10-year US government bond rate moved closer to 5% and even peaked above 5% for a short period of time, stock market pulled back. And now we're seeing the opposite effect. We're seeing the 10-year pull back below 4.5% in the last few days, again in the US, and we're seeing stock markets surge. And wanted to touch on a few things that have come out that has caused interest rates, that have caused the 10-year to pull back. We're also seeing the 2-year government bond rate in the US. Those seem to be the two, the 10-year and the 2-year bonds seem to be the ones that most people focus on. And the first thing is job creation. And we have a chart here, monthly job creation in the US. You can see that it is definitely slowing. The last bar there shows October grew about 150,000 jobs. And if you look and kind of eyeball it here, you will notice that other than maybe June of this year, the October number was the lowest number that we have seen in the past few years. Obviously, a monthly number. So still growing jobs, but not as much as, I guess, other months. And again, it lends itself to that soft landing scenario or that Goldilocks scenario. Not too hot, not too cold, but perhaps just right. So jobs is something that the Fed will look at. Jobs, the stronger the jobs creation, perhaps the higher the interest rates move. Another measure, obviously, for interest rates, a key measure is CPI, or Consumer Price Index, which measures, well, basically inflation. And we have two measurements here. We always talk about them. We have the headline number and then the core inflation rate, which strips out volatile food and energy. And you'll notice here that the core rate has now gone down to just 4%. I say just because for the longest time it was, in the high fours and it got to the low fours, and not many people were expecting the core rate to fall this past month, but it dropped from 4.1 to 4%. The headline number, which takes into account everything, actually fell from about 3.7% to down to 3.2. So we're getting pretty close to seeing a number on the headline inflation with a 2 in front of it. The market loved that when they got those numbers just yesterday. Markets rose in the US, and as we always say, Canada, Toronto stock market followed their US lead and moved higher. Markets are up 1.5%, 2%, depending on where you looked. They loved it. The markets love these numbers because it's telling us that we're still seeing growth in the US and maybe a little bit of growth in Canada, but we're still at the same time bringing down inflation. We also got a PPI number today. PPI is Producer Price Index, so kind of wholesale numbers, and that dropped as well. Retail sales, the chart on retail sales out of the US, and you can see here on the far right, you'll see retail sales number actually going negative. And we were expecting negative 0.1. We were expecting a negative 0.3. We got 0.1 negative on retail sales. And again, one of the lowest or one of the weaker retail sales numbers we've seen in a long time. And once again, maybe not good for the economy, but pretty good if you're the Federal Reserve and even, I guess, the Bank of Canada, because the hope is that we follow our U.S. neighbors to the south, and we start to see our numbers start to pull back a little bit as well. But again, not pull back too much, because we don't want to hear about this talk about recession, mild recession. So we want a slowdown, but not a complete, I guess, washout of growth. We still want to have some growth in the economy. So we want to keep an eye on interest rates, and especially all the macro data that go into interest rates into the number. And lastly, I think we have a chart just on the 10-year itself, and you can see with all the data I just pulled up and a slowing down of all that data, it's no wonder that we're seeing the 10-year bond move back from a peak at the end of 2021. We saw it, I guess, kind of spike up again shortly thereafter, but it's been on a downward trajectory, a bit of ups and downs here and there, but overall down to under 4.5% today. Second topic I want individual investors to focus on is this whole idea of investors' returns. And I want to touch on this for two main reasons. Number one, I want to touch on investors' returns because I've been getting a lot of, well, maybe not a lot, but a few questions about investors' returns. Why investors have not seen a lot in the way of returns over the last few years. And I guess when you look at or consider things, it shouldn't be a surprise, right? 2020, we had COVID, we had the pandemic. And really, it wasn't until the back half of the year that the stock market started to move higher in anticipation of better days ahead. 2021 was a fantastic year. 2022, the fourth worst year, as I've said on the show many times, for the S&P 500 since they've been keeping track. So all the positivity coming out of the pandemic and in 2021 was washed away in 2022. S&P was down over 20%. And this year, coming into this year, we really didn't know what to expect in the middle of a hiking interest rate cycle. The central banks around the world raising interest rates as aggressive as they have been doing. We didn't know what to expect. And it turns out, yeah, the markets have been doing well. However, if you factor out technology, or as we call it, the Magnificent Seven, or the biggest 7 tech names that are out there today, 7 largest companies, you probably aren't seeing much growth at all in 2023 either. So it's no wonder that if you take a look at a rate of return over the past few years, you're probably flatlining, or maybe you're squeezing out a few percent gains. Definitely not what many of us have been used to over the past decade. And we have a few charts that will illustrate what I've just said. First one is the S&P 500 index. You can see here that if you held the S&P, tremendous run in 2021, a pullback in 22, and you can see a bit of a surge in 2023 based on technology, as technology makes up about 30-40% of the index, but still not back to the highs of 2021. So if you're an index investor, which is my second point, someone who invests in an index, an ETF that buys the index, or an index mutual fund, you probably haven't made any money at all. But if you bought certain parts of the index, which we'll show you a couple of charts on in a moment, you actually can still make money even though the overall index has not done well. And wanted to take a next chart here, the TSX. Here's the TSX, and this chart even shows kind of a stagnant market or an index. You can see here that, again, reached a high in 2021, but really over the last couple of years, hasn't moved much at all. And we don't have much technology on our exchange. A few tech names like Shopify, etc., but definitely not as much or as many technology names as we see in the US. And that's why TSX this year is flatlining again, like the Dow Jones at best. And so back to this idea of picking winners and losers, not buying an index. If you were to pick the winners and losers over the past few years, you can still make some money in difficult markets. And one chart I wanted to show on that was the NASDAQ. And as I've said already, if you own the NASDAQ, and I show the NASDAQ because that is made up of primarily technology stocks, you've done extremely well in 2023. You're going from the bottom left to the top right There have been some ups and downs along the way, some peaks and valleys, but pretty much had a fantastic year. For those of you that have had technology as part of a diversified portfolio, you've done well in that part of the portfolio. Last year, as I said, not as good as this year, and one of the worst years we've seen since World War II. But had you owned oil investments, you actually fared decently, not as bad as the overall index. And so we have a chart on light crude oil. We can pull it up here. It's a chart. There it is. And you can see in 2022, we had a spike initially in the first half of the year. Prices came down, but then another upward momentum. And if you take where the year started and where the year ended, you did okay in oil stocks. A lot of them that pay dividends. I always recommend oil stocks that pay dividends. You want to earn something while you hold out or wait for all this volatility to work itself out. So once again, owning index funds or an ETF that buys the index probably haven't fared too well in the last few years. But if you own certain parts of the market, oil last year, tech this year, I think you would have fared quite well. So something to consider before you make your investment choices. Lastly, or our third point, is dividends. And we talk about dividends a lot on this show. Everybody talks about owning dividend paying investments, opportunity to make something while you wait for the growth. And we have a chart here. I think it's the first time we've shown this chart. And it talks about dividend payers, nice colorful chart here. And you'll notice here that second quintile stocks outperformed most often from 1930 to 2022. So what does that mean? Well, what we did, or what they did in this chart, Hartford Funds, is they broke out dividend payers into 5 equal amounts. So 20%. So the top 20% dividend payers, the second 20%, the third, the fourth, and the fifth. And what we found out was it's not so easy just to go out and pick the stocks that are paying the highest dividends, because you'll outperform the market 67% of the time. It's not bad, but nowhere near as good as outperforming the stock market 78% of the time, or almost 80% of the time. And those are your second quintile. So going after the top dividend payers, you can try that. A lot of them may cut their dividends when times get difficult. A lot of those stocks tend to be a little more volatile. You got to really ask yourself, do they have the cash flow to pay these high dividends? Or do you want to own the second quintile, the second grouping of dividend payers that are in that, let's say today, 4 to 7% range? These dividend payers tend to increase dividends over time. They tend to be less likely to have to decrease their dividend payments. I looked at Canadian bank stocks, great example of names that would fit in that range. And the last thing I want to point out on this chart is the third quintile actually performs as good as the first. So I don't think you're really getting any further ahead by chasing the highest dividend payers. I think you want to buy good quality companies that pay good quality dividends, that are sustainable and that are growing over time. And to me, that makes the most sense. I have 2 charts here that I want to highlight, 2 stocks that I've talked about many times on the show. First one is Bank of Nova Scotia. As I mentioned, Canadian bank stocks are really good, fall into that second quintile area, I believe. With Bank of Nova Scotia, when you're looking for growth and income, you're looking at a stock that is down significantly from their 52-week and all-time highs, and will pay you a nice, healthy 7% dividend while you wait for the growth. And lastly, Enbridge, a favorite company, a darling company of all of ours. We all pay our Enbridge bills, unfortunately. Enbridge is paying close to an 8% dividend today. So you're actually bordering on that second quintile to first quintile area. But I think that dividend is secure. And Enbridge has made a number of acquisitions recently, and their cash flow, I believe, is great, and their dividend is sustainable. So overall, these are the 3 things that I want everybody to look at and consider before you make your investment decisions over the next couple of weeks. The markets are volatile. The markets will continue to be volatile. But I think if you focus on where interest rates are, that is the number one thing to look at. And then you want to consider, what you're investing in, what your returns are looking like, what your options are. And lastly, to give a bit of a boost to that return, you want to look at dividend paying investments.